would you say this really is a unique thing? I mean, probably certainly in Switzerland, in Europe, worldwide. Do you know of another bank that is quite so deep into the space like Julius Baer?
I'm unaware of another bank offering having a house view for digital assets. I'm unaware of another bank allocating Bitcoin into the dynamic asset allocation of our CIO's discretionary mandates. So I think we're trying to be at the very top of it. We're trying to offer expertise across the whole value chain. And I think that's what the clients need, right? Mm-hmm. They're still going to hold their digital assets most likely. So why don't you just offer the best-in-class solutions in terms of custody, pricing, research, investment advisory, and so on.
Hello and welcome to another episode of RULEMATCH Spot On, the only podcast focused exclusively on the institutional crypto and digital assets industry. I'm your host, Ian Simpson, and if you want to know what banks, and especially Swiss private banks, hedge funds, asset managers, and others are doing in crypto and how they're doing it, this is the place for you. My guest today is Manuel Villegas. He is Associate Director and Next Generation Research Analyst at Julius Baer. Julius Baer, one of the largest banks in Switzerland and already a pioneer offering crypto investments to its clients for several years. And they have developed a very in-depth research team, one of which is Manuel, who will join us today. Manuel, welcome to RULEMATCH Spot On.
Thank you for having me.
It is very, very remarkable, actually, that we have you on the program today, since Julius Baer, as a private bank and one of the largest private banks globally, actually, has been quite early to offer crypto investments and to really get deep into the topic. Just tell us generally, high level, how the bank thinks about digital assets and crypto and how they approach this entire space.
So we see digital assets as another asset class out there, and it's starting to meet the likes of global macro investors, of long-term investors, and of some of our clients. And that's the reason why we need to cover the value chain as good as we can, offering research, a house view, and even investment advice on some of the tokens out there. So essentially lower down these educational barriers that we sometimes have to cover to enter digital assets.
We'll dive down into some of the details around how you come to those views and making your market views, but just generally, you mentioned some of the assets that you look at. The token world is quite broad. There are many, many tokens out there. I imagine you don't cover all of them. So track record, liquidity, some of those factors are very important. When you talk about those top 2, 3, Bitcoin, Ether, Solana, are those the things that you look at in order to evaluate the assets themselves?
So we attempt to look at on a very broad base. So essentially the research approach on a simplified basis has 4 prongs. So the top-down factors where we include global liquidity, where we include political and geopolitical outcomes. We also have the sentiment where we take a look at MVRV, so market value to realized value, and some other kind of crypto-native-ish sentiment indicators. And then we also simplified it quite a lot. So we have demand and we have supply. Mm-hmm. In the demand side, we check spot, we check derivatives markets. And in derivatives, we really like to check out the funding rates. We like the derivatives. And it's pretty interesting how the ecosystem has evolved. And as of a couple of weeks ago, we were seeing this huge skew for out-of-the-money calls following the US election. And what actually turned out is that the strike price that they were pricing in kind of materialized. So it's been pretty interesting. On the supply side for Bitcoin, we also have kind of these fundamental factors. We have the issuance of the network. We have kind of this inflation rate that is fixed every 4 years. Every halving cycle it changes. But we also have these other factors that influence the additional liquidity that might enter the market or not. So we have the miners. Mm-hmm. We try to check out the network hash rate. We use the US listed equities as proxies for this. We try to calculate a sort of a cost curve, adapting it from what we get from precious metals or so on to the crypto space. Obviously, here we would look at the hash rate instead. And because we believe as margins get tighter for them as well, more supply might enter the market. And on top of that, we have some, let's say, one-offs like the Mt. Gox redistributions and potentially the FTX in-cash redistributions in the next few months that might also impact the market. So
many different factors.
It's many factors.
But you're still looking mainly at the mature assets, like the mature part of the market, which tends to be kind of top of the market capitalization charts, right?
And we try to be a bit pragmatic about it. Mm-hmm. We like Ethereum, we like Solana, not only because of this more higher maturity they have against 95% of the cryptos out there, but also because of the use cases. Mm-hmm. So we need palpable use cases. We see Bitcoin as a store of value, and we see smart contract platforms as this infrastructure for the future where you can build upon, and where we're seeing traditional financial institutions build, right? So we're seeing the tokenization of financial assets, often referred to as the real world assets, really picking up. And I think it's something tangible. It's something people understand. It's something people can relate to. They understand that money market funds have become highly attractive in the US. They've been averaging a yield of around 5% on a year-to-date basis. Obviously, now it's going to be a bit lower. And in some cases, these money market funds can even buy the US reverse repo programs that yielded just marginally higher than the short end of the curve. So it's pretty attractive. And I believe crypto investors also may implicitly realize that there's some sort of DeFi risk premium. And as this became more compressed when the interest rates went up, you just realized, why would I take so much risk to do this liquidity pooling and get 6-7% when I can get 5.5% on a less risky US money market fund. So that's the reason why we also concentrate the coverage quite a bit.
And when we talk about the maturity of the market, of the crypto market, there has been this saying now for a few years, since my time in the space, I've heard again and again, the institutions are coming, and it sort of happens, and yet, meanwhile, in Switzerland anyway, according to FINMA's official reports, there are or were 34 banks already offering some kind of crypto service to clients. That's quite a level of maturity. And then you have ETFs coming out in the US. So more and more things happening in the institutional space. Where do you think it is when it comes to really actually having institutional adoption so far?
It's one of my favorite topics because this year has been crucial. It really marked a hiatus in what institutions could do with the ETFs coming across. So in Europe, we already had physically backed ETPs, right? It's nothing new for us. However, US capital markets are the most important ones. And we have to set that clear. And the approval we had in the middle of January this year for the US spot products actually changed the capacity institutions had to enter the space. So there were quite a limited amount of investment vehicles that these institutions could adopt. And also they weren't produced by the asset managers with the longest track record, which for especially long-term investors might be something that might hold them back a little bit. So endowments, pension funds, and the likes have all come across this year once you have some of the larger asset managers issuing the products themselves and at minimum expense ratios. So we're seeing 25 basis points on average as the expense ratio for these US spot products, which is quite low. So this development of the ecosystem and of the investment vehicles and of the avenues has actually, let's say, enhanced the capacity these long-term investors had to enter the space. So I think it's growing. You see so many traditional banks realizing these minimum viable projects on top of blockchain technology, whether it's for money market fund tokenization, whether it's as a settlement layer. There's quite a lot of things happening. And if you look in LinkedIn, you see how many employees they're hiring for digital assets specific roles across these traditional financial firms. On the other end, we have the hedge funds. And I guess this is something of the more, interesting factors out of the quarterly filings we have in the US for the ETFs. So you see the likes of Millennium, you see the likes of Jane Street, you see the likes of, Flow Traders, Citadel Securities, and so on, leaving some positive balance sheet exposure to the Bitcoin ETFs. They're the ones essentially in charge of the issuance and redemption of the shares of these products. And when you have such an opportunity in spot markets, and then on the perpetual futures, you're seeing funding rates that have averaged around 3-5% year to date. They have this amazing cash and carry strategy where they go long spot and they go short the perpetual futures. It could go, and they can gather this positive funding rate. So it's also quite an attractive trade.
They're getting right down deep into it. Meanwhile, some of those names that you mentioned, we think of flow traders especially, have been in the space already for quite some time. There's an article that came out recently in the Financial Times about DRW, also has been a big player early in the Bitcoin side. And so that kind of institutions that are coming may be true up to a point when we talk about pension funds, and yet some people have actually been doing a lot, maybe a bit under the radar, preparing themselves. Where do you think they got their research from to get started in the space? That probably was essential for them, right?
That's a pretty good question. I cannot answer. At the end of the day, I guess, media is also starting to cover it a bit more than they were a couple of years ago.
To light, yeah,
and you see it in the Financial Times, you see it in the Wall Street Journal. Like there's a comment on digital assets with a certain periodicity, which I think is quite important. But at the same time, you have some brilliant research firms out there that are really nailing it down on a bottom-up basis and differentiating best across the different blockchains there are and the protocols, how much revenues are these protocols generating, and it's quite interesting. So it's growing, but there's little firms out there that are actually imposing a rating on one of these digital assets.
We actually had a guest on the podcast just recently, small team, small firm hedge fund sitting here in Switzerland, rather small fund, but turning it 10 to 20 times a day. So their volume is very, very big, and they have already come through the second cycle of their tech and algo setup. So it's very interesting to see those people now moving on to kind of the next generation of things, even while some people are still coming in for the first time. Just going back to the ETFs, I mean, what kind of actual market effects do you think we have seen from those players, the redemptions and creations and so on, when it comes to cycles, also when it comes to weekend versus weekday trading and some of those things? Have you observed some different things happening since those ETFs went live?
We've observed plenty of things, actually. And I think one of them is how low the slippage and how tight the spreads between the bid and the ask have come across through the development of these ETFs. So actually the spreads for some of the ETFs are way lower than what you can see in some of the crypto native exchanges. So that's quite interesting. It's obviously depending on the liquidity. So for the case of the larger ETFs, you would have probably better spreads than for the smaller ones. And in the bigger exchanges, you would have better spreads than in the smaller ones. But in general, it has become quite the cheap means for investing, because the problem is that when the average investor tries to get into their crypto wallet, especially if it's a decentralized one, or their exchanges, they have to on and off ramp, and this imposes a cost a good percentage of the time. So that's actually going to set them back a couple, perhaps even a couple 100 basis points to enter and exit. So with ETFs, they just found a pretty convenient avenue. At the same time, most of the Bitcoin price movements have been happening Monday to Friday. And it's interesting how the ETF flows have actually ended up meeting the different prices. So it's kind of this leading indicator that we're seeing that's becoming also quite interesting. And a little additional comment here. Ahead of the elections, what we had is that as betting market odds changed, the first thing that changed was on the wrapper demand the next day. So the more...
So you see a connection there.
We saw a very strong connection, especially when Trump and Biden had the first debate, when Trump had, when he was tried to be assassinated, also when Biden yielded to Trump. So these events radically changed the odds of a Trump administration. The first two increased the odds, the third one decreased the odds, and what we saw is that ETF flows followed suit the day after, the week after, and with that you see prices reacting quite fast, especially when you consider that, for example, for the last week we had a day with almost 1.4 billion of net flows, net of the outflows also from some of the legacy products, and the market depth plus 2% is around 350 million for Bitcoin against stable coins in some of these larger crypto native exchanges. The authorized participants are buying a good deal of the Bitcoins in these crypto native exchanges, and also another good chunk in an OTC basis. So it's interesting that this is actually affecting the market as we see.
Those political events you mentioned, some of them, we'll come back to the political side in just a minute. That's very much kind of things that you would look at from a research analyst standpoint for equities, for other asset classes. Do you think that's more now in the minds of crypto researchers like yourself and perhaps other places than it was before? Crypto now being affected by more typical geopolitical events than before, or not necessarily?
I think the right approach for researching crypto, specifically what is Bitcoin, now that institutional investors have started to kick in, and what is Ethereum as well, is to see the asset class behaving in line with global macro assets. So on one end, we have a strong conviction that these top-down factors impact the short run of these assets, whether it's US macro, whether it's US politics, or whether it's this more global geopolitical state. So it has had a certainly strong impact when looking back. Regarding the rest of the tokens, we see crypto as a risky asset class. We see that lower interest rates benefit crypto the most, specifically because of this idea of a DeFi risk premium we mentioned before, and because the opportunity costs, when they're going down, essentially give a better outlook for digital assets in itself. So obviously, we have the strong conviction that lower interest rates would lead to a better environment for digital assets, as well as growth in global liquidity. So whether it's because of this debasement of the US dollar theory or not, what we see is that growing cycles of US dollar liquidity, specifically measuring the size of the Federal Reserve's balance sheet, meet better times for digital assets. Cryptos, in terms of the altcoins and all other equities that are high beta plays on Bitcoin, so the likes of the miners, the likes of these equities that are having Bitcoin in their balance sheet,
MicroStrategy,
the likes of some crypto exchanges, result in a high beta play on Bitcoin. And they tend to perform best on Bitcoin when the market is trending.
Let's turn now, you mentioned slippage on the ETFs and things like that. Let's turn quickly to a topic kind of adjacent to that. Some of the conversations we've had with people in the institutional space, but also from the regulatory side, bring up the topic of best execution. As a financial intermediary, a bank, and also serving clients, that's very important. Some people say that best execution isn't really possible in crypto since the market is so fragmented here and there and everywhere. How do you think this is developing, and how are you thinking about this when it comes to prices and price movements?
I agree, actually. I think it's not ideal at the moment. It's improving quite considerably at a very fast pace, but I think it's not there yet. I think it's difficult for some providers to have the capacity to have the liquidity with Coinbase, with Kraken, and with Binance at the same time. So some of the more liquid exchanges have the tendency not to be most clear in terms of regulation. So it's difficult for a particular regulated institution to be able to source liquidity from every single exchange out there. So, but I guess it's been improving quite consistently, and also the development of these wrappers on the ETFs, or the growth in the derivatives. We have around 20 billion of open interest in options, in derivative. We have around, I think, 40 billion in open interest for futures, including the perps as well, and the dated contracts from the CME. So it's growing. It's growing at a pretty fast pace. And I think that if you draw parallels to other asset classes, especially when people look at gold ETFs at the beginning and Bitcoin ETFs now, you see this huge growth, this very fast-paced growth for the digital assets products and ecosystem.
And because as a bank or a financial intermediary with a fiduciary duty to your clients, you're watching all of these factors, trying to see hopefully how you can serve your clients best. That also includes counterparty risk, but then finding the best price and the execution for the size that you have. That's a pretty complex thing for even a sophisticated bank to think about and work with, right?
Agreed. I mean, it's as complicated as it gets. We try to offer the best in class in terms of custody and security for that matter, but it's a process. It's getting better as the whole space evolves and as our capabilities evolve and as the rest of the market's capabilities evolve as well.
And so diving down into just how you work and your focus with the research at Julius Baer, you mentioned some of the factors you look at for evaluating things. Fundamentally, like there's market structure, then there's kind of token fundamentals, but then you mentioned also regulatory and political. What is kind of, first of all, kind of the weight of those things? Which are most important for you to consider?
So on the short term, I have to say that the top-down factors will be driving prices the most.
Regulatory, political things, yeah.
Because you see the effects, as I said before, right after on the spot wrapper flows. So ETFs, ETPs that are physically backed, you see the effects quite fast. On the medium and longer run, it's more a bottom-up approach. How the blockchain is developing. The use cases are pretty important, and that's kind of the way we look at it a bit more. So in the short term, top-down factors will be on the driving seat most of the time.
And market structure or tracking the liquidity across exchanges, venues, that also factors in, I imagine.
That's pretty important as liquidity grows, and people are more willing to return to what we had on the exchanges, and now you have it on traditional financial exchanges. It's obviously super important for the development of, the capacity also for institutions to be able to get exposure to some of these tokens, because if the token has minimum liquidity, it's going to be a very difficult case for them to onboard the token and potentially offer custody on it.
We talk sometimes about price discovery in crypto, since it's a bit different, right? As a global market, especially for the most liquid assets, you kind of have this trend, right, where it starts in Asia and it comes across to Europe, then to the US. It's been this way for quite some time. Do you see anything changing that, or do you think that's going to continue to be the cycle to track as things kind of develop across the day? How do you track those kind of price movements or cycles, so to say?
I think as we speak, it's mostly happening on U.S. market open hours. In March, it was quite interesting that we saw, and in February, just before these previous all-time highs that we had, which were quite persistent, we saw how Asians were completely off, because it's very difficult to attribute that the price increased, because of Asian exchanges at this particular time, because the data we have access to is pretty limited. What we can actually see is how much Bitcoin appreciated during Asian trading hours, how much Bitcoin appreciated during, European trading hours, and how much it did during New York trading hours. So having this approach, we sometimes see clear trends. However, as of late, it has mostly happened during New York trading hours.
Also an effect of the ETFs, would you
likely
say? Most likely.
Look, we have 26 billion in net flows since the beginning of the year for the ETFs. We have, these are the US ETFs alone. We have almost, I think, 78 billion in assets under management for these US ETFs. If we include the rest of the world's ETFs, we have around 105, 110 billion in AUM for ETFs and ETPs containing some digital assets exposure. So it's happening primarily due to the ETFs, they've become the avenue. The same way ETFs became the broader avenue for retail investors to get access to equities, they're also becoming the avenue for some retail investors to get access to crypto.
So now let's come back to the big topic in the room, the U.S. elections, which obviously were quite a big thing on many people's radars. People were getting quite worked up about it. There were many theories before the election how this might affect crypto markets. Now the election has happened. Trump has been elected. And based on at least initial evidence, that has had some effect on the market. Do you think this was just sentiment, or do you think there are some deeper things that are driving this shift under under the new presidents coming in?
So I have the strong conviction that everything is based. What we have that is tangible is the expectations on changes in the regulatory backdrop. So for that matter, abstaining from the World Liberty Financial Token that Trump was championing before, abstaining from the political action committees like Fair Shake that recorded these hundreds of millions of dollars for funding of the Republicans, and also abstaining from the potential creation of strategic reserves for some states. The regulatory backdrop is quite clear. Until now, we've had multiple prongs. So we had the Securities and Exchange Commission, and the chair is Gary Gensler. And the approach to regulating digital assets has been quite, let's say, gray. So to a large degree, some of the tokens were seen as securities, as investment contracts, based on the Howey test that's almost 100 years old. And essentially, they determined that an asset was an investment contract if it was an investment of money in a common enterprise with the expectations of profit coming from the effort of others. It's quite a broad category. And if you wanted to include some of the proof-of-stake blockchains in here and some of the assets that are living in some of these blockchains, you can really draw some parallels in many instances. The problem is that this approach is almost 100 years old, and things have certainly changed. And before this approach was championed, the CFTC, the Commodities Future Trade Commission, actually had enabled futures, Bitcoin and Ethereum, and options in these futures. So they were seeing the asset as a commodity. Important thing is that the SEC drives clarity going forward. That crypto service providers, asset managers, and the rest of the financial world can actually differentiate between a token that is a commodity and between a token that is seen as a security. In that way, they know which assets they can offer for trading, in the case of the exchanges, which assets they can offer for custody, and which assets you can maybe develop some wrappers on, right? So I think that's quite important. That's the first prong of the approach. I think there are 5. The second one is regarding the Treasury. The Treasury would have the Internal Revenue Service as a key, let's say...
enemy to some people? Just kidding.
No, there might be some changes coming across also on the IRS, especially regarding anti-money laundering and Bank Secrecy Act standards for digital assets, particularly in regards to self-custody. And then we have the 3 big legislative changes. So we have this stablecoin bill, which I think is quite important. I think stablecoins are one of the more attractive use cases you have for crypto as a payment mechanism to a large degree, and potentially in the future, what gives maybe a tokenized money market fund actually that gives back a little bit of the yield to the holders. On the other end, we have self-custody. So last year, we already saw how Congress was trying to deny this SEC ruling to prevent some custodians that are not qualified custodians for the SEC from custodizing digital assets, right? And we saw how actually it ended up in Joe Biden's office, and he had to veto the overruling of Congress for this to happen. So we expect more clarity coming across in terms of the custody side as well. Lastly, there's this Financial Innovation Technology for the 21st Century Act that's going to bring a broader scope of regulation for the asset class, and this has been championed by the U.S. House of Financial Services in the past couple of years. It has been introduced and reintroduced, and I think this is going to be quite important for the entire ecosystem to evolve. Back to the SEC, I didn't say it before, but what we also have, what the market is also expecting, is that Gensler steps down. So historically, independent of the fact that a Republican or a Democrat, the chair of the SEC tends to step down as the other president gets into the office. There's obviously some added pressure in this time around, but yeah, expectations on Gensler stepping down are quite important. In general, I think it's very important also to say that, Kamala was not Biden, right, all along, but she had been the vice president for the past 4 years.
Yeah.
So that's pretty important. And I think the reason the prices rallied way more than what markets expected, it's because the markets weren't pricing in a sweep, a full sweep. I think the market was, positioned towards a victory, to a certain degree of uncertainty, and with a black swan tail risk scenario of, contested results and potential unrest. But as the Senate majority turned in, and the House is also looking more towards a Republican scenario, I think that's what the markets have been also banking on, because Congress is actually most important in terms of this.
Passing legislation.
Exactly.
Yeah. So all of those things, very rightly focused on the regulatory side, and that kind of potentially opens the door for many more institutional money to come into the space in the U.S., and the U.S. market being as huge and important as it is. There was also the statement from Trump. Again, hard to analyze that in detail, but he made the statement, we want Bitcoin made in the USA, which would seem to be directed towards mining operations in the U.S. Also, there was some mention of a strategic Bitcoin reserve being held even by the U.S. government. Those are other factors that could potentially affect the supply, demand, or access to Bitcoin at least, right? What do you make of that?
For sure. I mean, this is one of my favorite topics to talk about, the mining sector. I think it's brilliant, especially now that you have this certain competition from artificial intelligence data centers and this commoditizing of the energy sources. And, Bitcoin miners have had this essentially joker, because they have 6 gigawatts of energized capacity. I'm talking about the publicly listed ones in the US, and they have 10 gigawatts of contracted capacity through the end of 26. And it's taken from the company reports. And AI data centers are, their mouth are watering when they're seeing these numbers. It's pretty attractive. So this obviously gives them a little bit of optionality. And the way it works is that they were under stress in June, July. So we saw an increased number of Bitcoins re-entering the market. So they had to sell a bit more to cover their fixed costs, because prices dropped a little bit below their average cost of production. We have quantified an estimate of the range of their average cost of production. And for this US cohort, we have, an average sitting between $53,000 and $56,000 US per Bitcoin. And if we expect tax cuts coming from a Trump administration, miners are going to be benefited in many ways. So essentially, their margins will be a bit more relaxed. They will be a bit more wide, and that's all positive. So the better the miners, the better the margins the miners have, the less Bitcoins are likely to enter the market under a potential retracing of the prices. So that all solidifies the backdrop for that. At the same time, if you are having additional optionality with the energy, you might be wanting to trade the energy, and you might get some additional income on that. You might reinvest in the more efficient mining chips in the top ASICs, and it's all going to improve the broader ecosystem. If Trump actually manages to continue concentrating the hash rate in the US, it has actually been concentrating quite a lot in the US when looking back, or by US listed firms at least. Some have operations in South America as well. I think it's going to be quite positive for the space, because we can track public companies. We cannot track the mobile miners in China. We cannot track those in Eurasia. It's quite tough.
And then there's that topic of a strategic Bitcoin reserve where, the government says we want to hold this thing, we want to have this thing for us, the U.S. as a store of value. Could that potentially kick off some kind of competition then among other governments and central banks who see, okay, the U.S. is doing this, and if the biggest market is doing this, we should as well? Could this be a dynamic that comes into play on the back of Trump's election?
He's made public statements about it, right? But nothing is set in stone. And what we've seen actually this year is, we still have a democratic term, right? And we still have a bit over a month and a half of it. They sold some of their seized assets in July, if I recall correctly. And that brought quite the overhang to the market. So I think it's quite, based on rumors. And from the statement to the fact, I think we have a long way. I think it's going to require a lot more for this to happen. Actually, so this is not one of the reasons why we believe the Trump administration is best. Obviously, if he creates a strategic reserve of Bitcoins, prices are going to go in one direction,
And perhaps even the statement that he might or potentially would do that might kickstart at least some thoughts and potentially some quiet moves by other people. But again, speculation.
Absolutely. I mean, we're seeing the market. I mean, over the weekend, it looked like animal spirits. Bitcoin reached 82,000 this morning, actually. So, I believe most of these speculative comments are priced in.
And you mentioned stablecoins. I wanted to come back to that one because that has also some geopolitical undertones. I remember an article from Paul Ryan, the former Speaker of the House, in the Wall Street Journal a few years back, but then, of course, others have talked about this too. Stablecoins, especially very large ones that hold liquid assets as backing, that includes U.S. Treasuries. That makes them very important buyers of U.S. debt. Do you think that going forward, this may be a more strategic geopolitical play also to support the use of the dollar going forward as the world becomes more digital, but then the U.S. wanting to maintain its place in the world? How do you view that development? Also on a macro and
no, I think stablecoins have evolved quite a lot as we know them, right? So we have the two big providers. So we have Tether and we have Circle. Circle has their operations regulated in the US. Tether does not, right? And essentially, there have been also many opportunities emanating from this tokenization of real-world assets. And essentially, when you're tokenizing a money market fund and creating a single asset out of it, technically creating a stablecoin. The only difference is that in this case, Tether and Circle are managing their treasury and they're not exactly giving back any of the yield to the end clients. And in this other potential case, the end clients might receive some of this end yield. So I'm very eager to see how it will all evolve in the sense of will you maybe be potentially able to trade against these tokenized US money market funds that are, rebasing and that's pretty interesting going forward. In terms of how many treasuries the stable coins are buying, it's also ridiculous, right? So it's only cementing to a large degree the case for the US dollar. You see very little liquidity in stable coins of other currencies and also some of the commodity-backed stable coins. So fiat-backed stable coins remain in top of the class.
And yet you have also in Europe anyway, MiCA is now coming into force, and there are also some provisions within that to promote euro-backed stablecoins or euro-denominated stablecoins. This could be potentially over time a bit of a contest, a bit of regulatory not arbitrage but contest and rivalry going forward.
Absolutely, it's potentially it could happen. At the end of the day, investors are going to look at what's yielding most, and it's going to be difficult that this European, treasury management is going to yield more than the US one. So let's see what happens on that regard. MiCA is quite broad, and it's also quite complex to navigate. So we believe that what happens in the US is actually leading what happens in the rest of the world, including Europe. And we've seen it across other asset classes, across other segments, how European regulation tends to be a bit tighter and constrains innovation a bit more than what we see in the US. Mm-hmm. Switzerland is an exception. I think FINMA has really championed the development of the asset class here and is aiming for the highest level of clarity. Mm-hmm. So pretty eager to see what happens, but I have no significant view towards what MiCA could
potentially do
exactly.
in the short term. It is hard to, as you said, hard to navigate, and some of the final rules or final provisions are still being written, which makes it difficult. I assume you would say that FINMA's stance towards token classifications and so on in Switzerland already very early 2018 really helped support what Julius Baer decided to eventually do in offering crypto investments to its clients, right?
Agreed, 100%.
Mm-hmm. And just going back to that and how you approach clients, you mentioned before you think of Bitcoin as a store of value. That, of course, was a debate for some time, whether it's a store of value, a medium of exchange, a unit of account, but it has kind of tended now towards the store of value. How do you think different coins are finding their use case over time? Will some continue to be used in multiple ways, or will they eventually probably all tend towards one specific use case, high level?
It's pretty interesting because that's a big problem institutional investors are facing when deciding if they should allocate
to put them in, yeah?
Exactly.
How to
and if they should allocate into Ethereum, Solana, or whatever else, if they had already allocated into Bitcoin. So some might say, they could diversify their diversifiers. But this case for Bitcoin is pretty clear. It's a store of value for many investors. It represents a role in a traditional portfolio. We see how even after rebalancing every 6 months, trying to follow either volatility criteria, semi-target standard deviation, or even drawdown criteria, a portfolio allocating a small percentage to Bitcoin tends to outperform a traditional portfolio, let's say 60-40, US equities, US fixed income. So we have this return enhancer, we have this diversifier. It's true that correlations change. Right now, the correlation is relatively high. When the market is trending, the correlation of Bitcoin to risky assets, specifically the S&P or the Nasdaq, tends to grow a bit more. However, if we see the correlations between Bitcoin and Ethereum, they're a bit higher. So the added value of the additional diversification tends to be reduced. If we look back, however, the returns that Ethereum and Solana, for example, have offered have also been quite more attractive. So we actually maximize the Sharpe ratio of this portfolio with a relatively small allocation below 5% to Bitcoin, actually around 2%. And the added benefits of diversifying this diversifier, including Solana and Ethereum, tend to be marginal to a large degree. So it's quite important. It's quite interesting. For the portfolio case, we want to see the assets as a store of value. For everything else that is happening, we see the smart contract platforms like, I say Ethereum and Solana because those are the ones we have coverage open on, but we have many. We see, also the layer 2s on Ethereum growing quite a lot lately. Some question their use cases and some question their position towards the fees, right? But it's been growing. You also have the likes of Near protocol. You have the likes of ICP. It's all becoming quite interesting. And these are the places where investors have a higher capacity to build upon, right? So I've mentioned it once and again, tokenization of financial assets. We talked about money market funds before and US treasuries. Private credit has also been growing at quite a fast pace. I guess altogether there's around 15 billion in tokenized assets. So equities are still relatively small, but we have private credit as the largest one. We have money market funds and US treasuries as well. And then we have alternative funds that are also growing. So these use cases are only likely to be developed on these smart contract platforms, and I think that's pretty clear. In terms of payments, these platforms are also the ones enabling stablecoins. Stablecoins are the means of payment for those coming from, let's say, underrepresented regions in the world that they don't really have access to capital markets, financial markets, or to a hard currency for that matter. So stablecoins are serving quite a clear use case in that regard. Whether or not, it's evading sanctions or not, that's not the topic of the discussion. They're providing some clear use case in this regard.
I remember an article that came out just after the ETFs were approved in Bloomberg from Matt Levine, who was basically saying that with these ETFs, you have now basically narrowed it down to store of value as the use case for Bitcoin, right? You put it into the ETF, it sits there, maybe shares in the ETFs are created or redeemed, whatever, but it's there, it sits there. Then you put other assets, Ether, Solana, also into an ETF or an ETP and try to or isolate it in that particular use case. Meanwhile, there still are many other use cases that are out there. So that, as you said, makes kind of less sense for those other things, whereas Bitcoin seems to have kind of found its home.
The reason last year in July, when the ETF saga started, coming to meet our ears, and we believed Bitcoin was posed for, a better outlook, was on the supply squeeze happening. The dynamics between Bitcoin, Ethereum, and Solana are quite different, right? So Bitcoin essentially has a quota on the maximum market cap, on the maximum, circulating supply there will be, on the maximum supply of tokens there will be. So it's 21 million. It's disinflationary because the rewards are still growing the base of tokens. It makes sense as a store of value. There has been more criticism, and you see it also with the flows into the Ethereum ETFs that were also approved this year. There's actually been negative net flows, right? So I think there's around 700 million in net outflows from the Ethereum spot products in the US since they were approved. Most of this has obviously come from the legacy products that were initially closed-ended funds and then converted into ETFs. The use case for having Ethereum or Solana within a wrapper is different. Some investors will only invest in these if they're doing staking, for example, because what happens is that the total supply of Ethereum and Solana is not fixed, can grow. In fact, it has been inflationary and deflationary at many points in time. And as of now, if we're seeing year on year the supply to actually grow, it holds a more challenging use case for investors to hold on Ethereum straight up, not stake it in their portfolios, right? So it's very different in my opinion. And sorry to interrupt you. And the Bitcoin maximalists are probably revolting in their grave.
Sure. Because,
guess what? Now one of the largest holders of Bitcoin in the world became one of the largest asset managers. There's also one of the largest holders of every single asset out there, probably.
Some would argue not exactly what Satoshi had in mind at the very beginning, but there you have it. That's free markets, right? That's the way it works. As we kind of come to the close of the conversation, and not to ask you to really pull a crystal ball out of your pocket, but we always ask our guests if there is something out there, in whatever capacity, a trend that you see developing, that you're watching, that not many people are actually talking about yet, something that maybe people should consider or take a closer look at. Can you share something with us?
I wouldn't know where to start. So there's so many things we're attempting to look at on a daily basis. Not only on the Bitcoin ETFs markets, on the spot markets, on the derivatives markets, also on the wrappers side, and also on the proxy equity plays side. We see this interesting outperformance of the miners against Bitcoin spot price in the past couple of weeks with this AI play. I think taking a look at energy markets is going to be quite interesting, especially because of how much friction there is between the time you actually want to start a data center, for that matter, and between the time you actually can secure some energy capacity. So I think that is interesting. However, in the short run, let's say the next 3 to 6 months, I think all eyes will continue being on Jerome Powell and the Federal Reserve in the US for us, it's quite important to look at liquidity. So liquidity has been one of those indicators that has worked pretty well to tell the directionality of prices when looking back. I think it's important whether you believe it's for debasement or whether you believe it's just because of the better environment for risky assets. I think that's quite interesting, especially when we, separate this down. I mentioned before we see liquidity and we use proxy as the assets on the Federal Reserve's balance sheet. And what we currently have, even though we have the rate cuts, we continue to have quantitative tightening in place. And that's reducing the balance sheet by around 60 billion every month. If we expect this to be phased out within the next 6 months, it's actually going to stop this, is likely to benefit this environment in terms of liquidity in the US. On another note, we have the guidance for the Treasury regarding the Treasury General Account. So essentially, it's money that's out of the economy, and it's their current account of the Treasury in the Federal Reserve. It's actually 850 billion by the end of the year. As of now, as of last week, they had 850 billion. So we don't see this as a headwind for the liquidity conditions. And we have the reverse repo programs. There's around 150 billion as of last week as well committed to this program. And we also see this program being phased out through the next 6 months. If we include the discount window and we include the bank term funding program, which is a facility that was installed after the Silicon Valley Bank collapse last year, we have around 60 billion and will actually drain a little bit of liquidity. So net, we expect liquidity to continue growing in the next 6 months if we see an end to this QT phase. Obviously, at the same time, lower rates would likely be a better environment just because of the opportunity costs.
Very, very interesting. Manuel, it's been super to talk to you. And again, I'm very, very impressed, and hats off to Julius Baer for diving so deep into the topic and providing its clients with what is certainly very, very interesting views on crypto and digital assets. I look forward maybe to having you come back on the program again sometime soon. Thank you very much for joining RULEMATCH Spot On.
Thank you. Thank you for having me. It's been a pleasure and super interesting.